And welcome back to the Halftime Report. I'm Bob Pisani. Time for ETF Edge. Gold and gold mining ETFs at multi-year highs today after billionaire Ray Dalio recommended the yellow metal. This, however, as his own firm, that's Bridgewater, the largest hedge fund in the world, underperforms the market, notching a nearly 5% loss for the first half of the year. Here to discuss, Dave Nadig of ETF.com and John Davi of Astoria Portfolio Advisors. John, gold's been flat for 5 years doing nothing. Suddenly, in the last 6 weeks, it's gone through the roof. What's going on?
Well, I think there's three reasons. One is you've got recession risks that have gone up. Two, you've had rates that have been trending lower. And the third reason, if you look at 10-year real yields, it's gone from like 1.2 to like 25 basis points. So, overall, I think it doesn't cost you a lot to own gold as rates go lower. It helps diversification. It helps multi-asset portfolios. Since March 2009, S&P's up 400%. Gold's up like 50%. GDX is down 10%.
Yeah.
So I think the risk reward is pretty attractive.
Speaking of GDX, those are the gold mining stocks.
Yep.
Gold's been crummy for 5 years. Gold mining stocks have been awful, and suddenly they've taken off tremendously. Is there some reason to play gold stocks over gold, or have they got their act together more suddenly?
I think they've got their act together. We've had this sustained down market in gold miner stocks. That gave them the opportunity to close underperforming assets, to do some industry consolidation, which we've seen. And so we just had a technical breakout in GDX. This is something traders really pay attention to. So that puts a lot of tailwind behind this. I think either GLD or GDX are a good way to play a sustained rally in gold.
Now, you have a very interesting take on owning gold directly, not gold miners. Normally, of course, we bring up GLD, the biggest gold, direct ownership of gold in the world. But you like a different, a competing fund, BAR. Why do you like them, and what's the difference?
It really just comes down to cost. Both of these are funds that simply take gold bars and stick them in a vault. GLD charges 40 basis points. BAR, cheapest in the space at 17 basis points for the exact same exposure. If you've got to day trade this, if you need to put 100,000 shares through fast, GLD, of course, is going to be your institutional favorite. If you're a normal investor, you might be making a 5% allocation on $1 million portfolio. BAR is your bet all day long.
So very simply, though, it's basically you've got the fund there. The funds are the same. They're gold vaults, different gold vaults, but the gold's there. There's no structural difference here at all.
It could even be the same vaults.
I don't want to get the gold nuts yelling at me. The structure is the same.
Structure is identical. Yeah. Absolutely.
Okay, important thing there. Thanks very much, gentlemen.